Thank you for tuning into the All Funds Investment Podcast. This market update video is with Susan Barreto, editor of Alternatives Watch. In this episode, Susan gives us a market update on alternative investments in pension funds and endowments. We discuss investor performance figures, allocations, and changes that we're seeing being made to the traditional endowment model. Just a reminder here that nothing said is legal, tax, or investment advice. Check out the full disclaimer below. We hope you enjoy this conversation. Please like and subscribe if you find this information helpful, and check out the links in the description to connect with us and Susan. I guess to kick things off, let's start with investor performance. How have things been for the endowments and pension funds recently?
Yeah. Well, first off, thank you both for geeking out with me.
Of course.
You know, this is my favorite
Anytime.
thing to do, and time in Excel.
Yes.
It's wonderful. So I started out thinking, I'm going to just kind of look at endowments and see what's going on, because obviously we've had some big news with the Princeton Endowment, change of leadership there. And we've had, some other changes in leadership across the country for CIOs in general. It's been very, very busy. So that tells you something. Something's going on. Looking at our Ivy League schools, not that this is a way to pick a school going forward, how well their endowment performs, but it is a strategy. I know someone who used to do this actually when they were looking for schools for their son. But anyway, so Harvard, I'm just giving you the reporter's notebook here. So Harvard was up 2.9% through June 30th for the year. Yale was up a whopping 1.8%. They're always neck and neck. It's something. But then we get to Princeton, that has the change of leadership. So they were down 1.7%. That was their first loss since 2008. So
Very
that's
interesting.
something.
Yeah.
And then I have Matimco, which is MIT's investment office, and they were down 2.9%. And their investment director is heading to, you guessed it, Princeton.
That's interesting. I think with a change,
Isn't it interesting?
that things are happening. That there's a little bit of a, shake.
It's always little rivalries.
Yeah.
And a lot of people know each other within the Ivy League endowments, and a lot of people even outside of that in the endowment foundation world. It's worth noting they often are have been influenced by David Swensen at Yale with the traditional endowment model. But I think what I want to outline to you guys, and we can talk about this, is why that model is broken.
Yeah.
I mean, obviously those numbers tell you something's wrong here.
And I guess before we get into that, is there typically like high turnover for employees during this time of year, as we go into the start of next year?
Sometimes, but I would say that what I have seen over the last 6 months is different. There's just been a lot of movement. And we kind of had this a couple years ago in the healthcare space. And then it kind of ramped up again this year with a lot of healthcare CIOs changing roles, or a lot of roles going empty for a while. And it shows you that there have been so many performance challenges, and you can't just set it and forget it. So there's just a lot going on. I don't know if I want to make the bold disclaimer and then, nobody wants to watch your show anymore, but I don't want to make the bold disclaimer that the endowment model is dead. Maybe I'll just say, like Monty Python, merely resting.
Well, no, that's good though, Susan. Let's get into that. Maybe just talk about what is the traditional model, what it's looked like to this point, and where we see some changes going forward.
I mean, the traditional model has always been private asset led. Read into that, private equity led. And back in the day, Skylar, you and I remember, hedge funds were a big part of the endowment portfolios in a lot of these places. And now that has shrunk down. And they've just kind of doubled down on private equity in a lot of cases. And they're too big. A number of them are too big to get into venture capital unless, some of these state schools like, U of I, where I'm at, near University of Illinois, they have their own venture programs. They back their own, people on campus. So some of that has, just kind of ramped up in the last few years. But, the question almost then becomes what replaces it? Because if you have a 70-30 model and 70 equity, 30 fixed income, most of that ends up being private equity. and you don't really know what to do with fixed income, even though here we are at this weird time where fixed income is totally changing, 40 years after this bull run, and now what? So there's just a lot of questions that I think trustees are asking. And then you have to remember a lot of these trustees sit within private equity firms.
That's a great
So
point. Yeah.
there's just a lot of tussle that's going to be happening over the next few months, I think. But yeah, so I think the one dynamic that I noticed, and I haven't really dug in deep to say like across the top 50, let's say endowments and foundations, whether this is the case, but what I noticed was there wasn't a lot of private credit. So unlike pension funds, and I'll go through their performance figures too, they don't have much at all, if any, in private credit. Where it tends to hide is if they had a absolute return portfolio or a hedge fund portfolio. They kind of, a lot of those managers ended up doing hybrid funds anyway, so they would stick with that. But it's just such a tiny part. So, by comparison, we've seen large pension funds diving into private credit for the last 4 or 5 years, and completely different picture. Not to say there hasn't been, personnel turnover at various pensions too, but different picture in terms of performance. And I can get into some of that from my other spreadsheet work if you guys are interested.
Yeah. And by private credit, could you explain what that means?
Oh yeah, good call. Yeah, so private credit basically is direct lending, distressed debt, um, asset-backed financing is big in that space. Just anything that is, it's a privately held and traded um, book of credit. And the other interesting part of this, too, that people don't talk about as much is when you look back at private equity's roots, a lot of it was leveraged financing.
Mm-hmm.
And now look at what's doing so well. It's leveraged financing,
Right.
to some degree, but it's within credit. It's really the credit portfolios that are feeding, drum roll, feeding private equity. Because a lot of these deals are getting done because private equity can go to XYZ credit firm and say, hey, can you back us on this purchase of this new portfolio company? We're happy to take out a loan on the terms that you offer. And it's going to ramp up more because, as you've probably read or seen stories talking about how fundraising in private equity has slowed down quite a bit because the realizations aren't there.
Right.
So this is how they're funding the gap.
Yeah. So if you don't have a liquidity event or something happening, they're going through this process instead.
You got to have capital.
Right.
And so it in a weird bizarro sense, and you'll see this, and I don't have I have kind of averages here, but what you'll see is growing private equity exposure from public pension funds. This is US public pension fund capital that I'm looking at here. And then at the same time growing their private credit, not realizing it's almost like doubling down on credit.
Yeah, that's what it sounds like. It sounds like leverage.
Yeah. It's something. But anyway, so yeah, just so like we were talking about those top endowment funds, which are always considered to be the bellwether of how institutional portfolios should be run and how they should perform. So you're looking at anything from a positive 2% to negative 2.9. Okay, so that's not looking good. Okay, I think even my pitiful little retirement program did better than that. Yay. Anyway, so average overall return, and this is just like 20 randomly chosen pension funds because I'm just kind of going state by state here. What I found so far is the average is 6.4% annualized as of June 30th. Not great, but certainly better than the endowments.
Right.
I think the top ones were kind of hovering around 9%. So I can tell you who that was. That was New Jersey Division of Investment, Fresno County, teeny tiny entity, and Louisiana Municipal. above 9% returns for the year. So they're doing
Wow.
good.
Yeah.
And then when you look at like the US equity portion, which historically has always been kind of the big pot of money for these funds, that on average was 14.76%. So obviously something drug down the portfolio a bit or wasn't, credit out of all the alternative investment strategies, so private equity, real estate, hedge funds, infrastructure, you name it, credit typically was the best performing program. So that averaged 5.89%. So round that up to about 6%. So that has been a staple in a safe harbor for a lot of these public pension fund systems. But that figure is lower than what most consultants were telling them they would get, or even the managers themselves. They were saying, oh, well, anywhere from, let's say, 8 to 10% you should expect to average out over time, over 7 to 10 years, let's say. That sounds great. I don't see any reason for them to change in terms of allocating to credit. And when you look at where that money's coming from, it's coming from the traditional fixed income side of the book and cash. So that's kind of the trend there. But then, so when it comes down to what's actually dragging down the portfolio, here come our PE friends again who've been rattling the tin cup saying, please give us loans so we can keep making investments on behalf of our investors. The PE average was 0.44%. 0.4.
Wow.
Oof.
That's tough.
How does that compare to previous years? I assume it's typically a little bit higher than that.
Yes. And, usually kind of averaging out about 10, 12, 13%. But, we kind of had that bonkers year of 2021. And let me take you back to 2021 when it was a very different time. So many levels. Harvard, their private equity portfolio was up 77%.
Wow.
So talk about volatility, guys.
Yeah.
This is a new era that we're in. And then we don't have to beat these guys up so much, but we know that real estate's been challenged too. But the real estate portfolio is just, on average, we're about down 1% for the year. 1%.
Okay.
Yeah. So depending on the fund, of course, depending on, what kind of, if it was a core allocation or non-core, more niche-y type thing. But you want to know where else credit is flowing into the portfolio? It's real estate. They're putting real estate credit managers next to traditional real estate managers.
That's interesting.
Interesting.
Yeah, for sure.
Yeah, I mean, that's just kind of what I see from where I sit, and every day we're writing stories about just different mandates and such. So you kind of start to back up a little bit and you see this big picture and you just wonder what 2024 is going to bring.
Yeah, especially to your point, a lot of these, private equity is going to be a challenge, has been a challenge, to your point, and obviously real estate is another component. But are people leveraging up certain positions here? It kind of scares me a bit going forward.
Well, yeah, I would not want to be a trustee at this time. It's, oh my gosh. I mean, especially if you're a new trustee just trying to figure out the landscape and you're looking at old, maybe materials that tell you what the markets used to be like last year. Yeah, it's crazy because I was listening in. I don't know if I told you guys about this before, but I was listening in to the Alaska Permanent Fund Corporation's recent meeting that was held at the end of October. And it was a fascinating discussion, and kudos to them for making it a public discussion. And they have a really interesting board, including Britt Harris, who used to be at UTIMCO and Texas Teachers, serves on that board, and just offers some wonderful insights. So if anyone, with YouTube wants to look that up, look that up. But I would say one of the things that kept coming up in that discussion is they wanted to go from a $78 billion portfolio that they have today. This is a sovereign wealth fund. So they're not paying pensions out to people. They're paying out checks to, if you're, we should all move to Alaska because we get a check for just living there. Let's do
That's
it,
what I hear.
guys.
They give you like 5,000 a year or something.
Yeah,
That's amazing.
yeah. And some of this is, oil revenues, and it's reinvested, and it really, it's a 25-year-old fund, but whoever had the idea, it's a good one. So basically, I was just listening in on that, and they were talking about how did we grow from 78 billion to 100 billion? How do we get to that? And so they were just kicking around these ideas, and their consultant Callan was on the line, and they had another person on staff who handles risk management. It's fascinating. So they're talking about adding, no joke, portfolio leverage. And I kind of thought, well, this is weird because I've seen other stories just recently saying like, oh, CalSTRS is talking about adding leverage. But there was within the marketing or within the presentation, there was a whole document outlining how many public pension funds in the US and including one in Canada have already done this. And so there was this whole back and forth like, well, if we do this, this is like the worst time to do it because we're going to be paying a lot of money on this.
Right.
And then there was sort of this other take of, well, if we don't start laying the foundation now and have the legislature approve this move, we won't be able to do this till next year. Wait, late next year, maybe May at the earliest. And who knows? Some people think that interest rates could go down. So it's a fascinating discussion. I'm not going to say I'm an expert on it, but I just think that it shows you the bind that these groups are in.
Yeah, and almost like we have to throw out the playbook or whatever it was and write a brand new playbook going forward of what we're going to do, right?
Yeah. Yeah. I mean, this whole 70/30 with 30 being private credit or much of it, and then, 70% equity, maybe that's really like 40% stock market and the rest of it's private equity. That doesn't even seem to be working. So I don't know. I mean, I'm at a loss. I'm just kind of watching this, with my popcorn, trying to see what's going on next.
Now, to your point, I mean, the pressure of the political changes and everything else
Yeah.
that these trustees and boards will have to go through and are considering. To your point, um, that's a lot of gray hair for me if I had to be in that position for sure.
Yeah, yeah. Oh, yeah. I feel for them, and and these are well educated people who have a lot of experience, and they're not sure. So I just think it's going to be a really interesting year to watch. But I don't think anybody can make any fast changes. That's the other thing to remember because market liquidity has not been the greatest. I mean, if you have traditional stocks, sure you can sell, but to sell in a market that could be moving sideways at best, more likely down going into 2024, that's a hard call.
Yeah.
So I think there's going to be a lot of portfolios kind of stuck. But I'm
Yeah.
sorry, I don't mean to be Debbie Downer. We're going into the end of the year and there's less sunlight outside. I'm not trying to make anyone depressed, but these are just kind of the trends we're seeing.
Well, yeah. Where there's doom and gloom, there's also opportunity too, right? So just
That's true.
where they'll go with it, and to your point, some of the things. I mean, the leverage thing that you mentioned, that's interesting. I'm curious how they
Yeah.
obtain that leverage and how they're going about it. At certain levels, there's capacity constraints too, based on these funds, right, and how they go about it based on the mandates. I'm curious how they would deploy certain aspects of leverage.
That part I need to read more into or just kind of dive into because they were talking about upwards of 25% portfolio leverage, which sounds a bit bonkers to me.
Yeah,
But I think it was a plan in Texas is at 18, and then CPP in Toronto is at 25, and they've done it for years. And I'm like, well, that explains a few things about this direct investment portfolio they have in private equity. Maybe that's kind of how they've made that machine work. I don't know. I'm just guessing. Um,
yeah. Let's hear more
so
about that.
yeah,
Things
no things to dig into, things to keep me out of trouble during the long winter ahead.
absolutely.
And I guess moving forward, for the outlook for 2024, do you see more trend following occurring? Obviously these private credit investment vehicles have outperformed relative to some of these other allocations. Do you see more of that, more investments taking
I think
place?
I think so, because now I've actually noticed, and if you go on our site, you'll see some of this too. I mean, the RFPs are starting from these small plans. I know like somebody might say, oh, Louisiana municipal sounds small to me, but that's actually large compared to some of these little teeny tiny municipal plans, like out in Massachusetts and such. But they're diving in. And, you're talking $2 million mandate. You're like, oh, does this really move the needle? It does. And that they're willing to even entertain this notion, by they I mean the managers, that tells you they know this is the time. You got to strike when the iron's hot. And they're going to do it because they do have money to deploy. I mean, they do have places to deploy this. There is a need for things to be funded. I mean, this is how the system works, and it's how the economy grows. It grows on the back of debt. I won't get political. That's a whole other discussion. I will not put a horse in that race.
No, it's a tough call. And to your point, we just mentioned, these smaller, opportunities that they're going after. I mean, sometimes it is easier to deploy something that is a smaller, capital size versus something that's very larger, much larger
Yeah.
as that goes. I'm curious how, because that may be an advantage in this case for them to be able to, because they.
Well, I think there's going to be some more like fund of fund type approaches. You know me, I come from a fund of hedge fund background, but I think there's going to be more roll ups of these types of things, because you're gonna see some of these smaller endowments and foundations wanting to get into this too. I mean, they have to some degree, but not. The public pension space has been where it's been really moving fast.
Yeah.
And private equity will still see capital flows, I think. I mean, what we've just been seeing is just a lot of re-ups where they can. So that's still happening too. And our friends in hedge fund land, I'm really hopeful. I listened to the Dan Strackman interview you guys did, and I was like, yay, Dan, yes, say it. Be right. Please be right.
I mean, hedge funds.
Dan's rooting for the hedge funds.
Yeah, we're always rooting for the hedge funds. And I really do think that there is a time, and, and some of this goes into the crypto markets too that you guys are so familiar with. But I think that there has to be a hedge to some of this, because it doesn't make sense to keep going at the where everyone's chasing the same private deal.
Yeah.
You got to diversify. So to the point of, trend following, will they finally get some love? I mean, I hope so, because even though commodity prices have been pretty soft, and, financials and metal prices have been strong, but it's just been a hard thing to kind of navigate as well. But I think more investors might be looking at those kinds of opportunities. I'm hopeful.
Yeah, I think it makes sense. I mean, just at this time, looking at where the S&P 500 is at.
Yeah.
I mean, it looks like we're in a consolidation pattern, for the next, handful of months. So just going long, kind of to Dan's point,
yeah,
might be a tougher strategy than maybe trying to hedge a little bit here.
It is. And I think though the problem is, and this always happens every time, it's always a global macro guys go in hot and heavy right away, and then they get their, butts handed back to them. And then everybody's like, oh, that was too soon. And the basis trade thing. Too soon. But who knows? I mean, you have to act on the information you have and your historical figures. And there's something to this idea that, yes, we're in a new market era, but yet we've seen it before. So you kind of have to parse out the different pieces. I know that's not saying much, but it's hard to do that. And I would trust somebody who's done that before, say in 2008, over somebody who's never seen that kind of market.
Well, you have some certain emotional understanding of what happened in the past and be able to withstand some craziness, right? So they say history repeats itself, or not exactly, but it does rhyme.
Yeah, no, and God forbid. I know there's some people talking about like there's going to be some massive crash and deflation, and it's going to be Weimar, 1930s all over again. I don't know. I've heard a lot of doom and gloom from my trend following friends in Chicago, but it doesn't usually play out quite to that degree.
Yeah, it's usually
Um,
a twist of something else, right? Or some other
yeah,
opposing force, you know. Again, eventually,
and
if you say it for long enough, you're eventually right one way or the other, I guess.
no, that's true too. And
Right?
then but then there's a lot of folks, who are like, and I kind of felt like this a few years ago, like this private credit thing. This is crazy. It's just growing so fast, But what and how does that end up? Because there's got to be a law of diminishing return at some point. And I guess my main concern is when I'm looking at all of this, with the pension funds and what they're thinking about doing. I just feel like we're doubling and tripling down on something. And while you can say, well, private equity isn't doing that well, and they may not have as much money flowing in, well, they seem to still be having flows and you know where it's coming from. So you kind of wonder all this interconnectivity where it goes.
Yeah, yeah, definitely. Just has two words come to mind: adaptability. He or she who can adapt quickly and be resilient amidst this chaos of uncertainty and things that are happening will definitely
Yeah.
prove out.
And we didn't even go into geopolitics.
Yeah, very true.
Let's just shove it all into gold and be done with it.
There's people that would state that they've been saying that for years, right? We all know who they are.
Get a few of them on the program. I want to see them.
Yeah, we need to find a good gold bug.
Yeah,
Yeah.
I think
You know
Yeah.
anybody?
There's a
yeah,
money.
yeah. There's a few out there.
Sprott guy. Yeah.
Yeah, absolutely.
Do you have a gauge of sentiment, Susan, on your end from different managers you talk to, from things that you see in the market? Do you have any idea of what the general sentiment is as we head into 2024?
Well, I guess if I had to think about it, I feel like it's go long or go home. I mean, it's just if you're gonna hold on to something and you think that rates could go long, could be held out longer than what the market is telling us right now, the public equity market, just hold on to things that you're comfortable with holding on to them for a full upwards of a decade. I mean, just really be confident in your underlying assumption of things, because there's a lot of asset backed financing that's happening, consumer loan financing, things like that. And I don't think they would be making those loans if they thought that, there was going to be some credit apocalypse on the horizon. But at the same time, I think they're very cognizant that they have to be mindful of what they are holding on to and be comfortable with the length of time that it'll take to be fully paid back.
Yeah,
That I think it's just you're holding out for longer. There's
Yeah.
not going to be the quick trades, and in the secondary market, the you'll see more growth in the secondary market if people really need liquidity. So it's available. It's not cheap, but if you're willing to hold on, it will pay off. That's kind of what I'm sensing people saying.
Any any other thoughts? Anything else you want to talk about? Any other topics?
Oh, I could go on for hours, but yeah, I think this is it for now. I have to go back to my Excel spreadsheets and actually finish writing some of this up. But oh yeah, one other thing, just since we're going into the silly season quickly, I will mention that we do have at Alternatives Watch. Here's my plug. We will
Please.
have a Black Friday sale.
very nice.
I'm just going to put that out there. So just pay attention.
Is there any more
Subscribe.
details around that, or we should be hanging on pins and needles and take a look at what's?
Well, just take a look, but I would say if someone watching this is not a free email subscriber, do it, because that's how you're going to get a sense of the deal.
Yeah, and for the audience, there's Susan and her team put out a great content on an ongoing
Thank you.
basis. A lot of great things you can be abreast of and pay attention to in the marketplace.
I got my gray hair back here to prove it that we know what we're doing.
You guys put out a lot of content, which is great, right? It's
Yeah, no, it's fun too. I have to say, we do have a good time. Maybe again, we're dorks and we like Excel a little too much, but we do have a good time.
any other interesting stories that have come your way in the last month or two? I guess.
Other things that we're looking at,
Yeah.
Artificial intelligence and how investors and managers are using it. That's something I want to dive into going into the new year. And we have an OCIO survey coming out.
OCI outsourced Chief Investment Officer survey.
Yep.
Okay.
So that'll give you some more sentiment out there about what they're thinking of the marketplace.
Yeah, we'd love to hear more about the AI conversation, as a lot of our guests have been speaking about it, and just get their sense of what they're doing, whether it be in their business or with their client base. Love to kind of hear your thoughts as we move forward into the new year. It'd be great.
Oh yeah, yeah, definitely. And I'll be watching and make sure if there's any little nuggets of wisdom I can glean too. So thank you guys.
Absolutely. Always great to have you, Susan.
Good
Thank you
to
so
have you.
much, Susan.
Yeah.
Final plug real quick. Where could people go to connect with you and learn more about Alternatives Watch?
So just simply alternativeswatch.com. And you can also find us on LinkedIn and Twitter. I'm sorry, X. It's X now.
X.
We did
It's
change.
X now.
Yeah. And even Instagram. We even have an Instagram account. You know, if you really want to see a lot of Excel spreadsheets in Instagram form, we can do that too.
There you go. I'll make
That's
sure to
your
follow you
thing.
there.
Little Excel B-roll on a video on Instagram. That's awesome.
Yeah. There you go. There you go. Anyway, but yeah, no, definitely just alternativeswatch.com. And there's on the side, there's a little spot where you can subscribe to the free email newsletter and get daily headlines. But then if you want the full Monty, you can subscribe, but I would wait till Black Friday. That's my tip of the
Noted.
week.
Great. Awesome.
Thank you so much, Susan. This is a great. I hope you enjoyed this conversation. Please make sure to like and subscribe for more content like this, and reach out if you're interested in starting a fund, whether it's a hedge fund, VC fund, whatever fund you're thinking. We can help you out, and let us know if there's any other topics that you'd like for us to cover. Thanks for watching.